Hello, everybody. We're going to talk about the estate tax and gift tax today. Just want to give you a quick overview. Now, the estate tax is part of the transfer tax system, and Congress on January 1st, 2013, they enacted a new law. The estate tax has always been kind of something debated quite heavily in Congress, and they entitled it the American Taxpayer Relief Act. Well, in addition to extending Bush-era tax cuts for 98% of U.S. taxpayers, the new law also makes the permanent change to the federal estate and gift tax rules. So that's something we have to be very well aware of. The change and the highlights are what? So they raised the estate exemption to 5.25 million for all deaths 2013 and thereafter. Now, what that means basically, if people who pass away, there's really only 2% of the people in America that are going to file an estate tax return. But it generates a lot of questions in Congress, a lot of litigation in the courts. But now 5.25 million, you got less than that, you don't really have to worry about this. And the estate tax rate was set at 40%, up from 35%. Federal estate and gift tax unification was extended permanently. So there's an interaction there. And the generation skipping transfer tax, the exemption amount is the same as the estate tax, 5.250 million. And extends the ability of a deceased spouse estate to transfer any portion of the deceased spouse exemption amount to the surviving spouse. So if one spouse dies and doesn't use up the whole 5.2 million, you can transfer it to the surviving spouse. Increase estate tax applicable exclusion amounts. See how they've gone up from 1.5 million up to 2 million and then 5 million, and now we're at 5.120 for 2012, and now 2013, $5,250,000, and that's where it's going to stay. It may go up, maybe index for inflation, but the idea is to get some stability so people know what they're working with. It also excludes a great number of people from the estate tax, which is what they want to do. So when we talk about the estate tax, we have to what? Compute what? The gross estate. Gross estate is all property in which the decedent had an interest. It could include certain transfers made, annuities, joint estates it has, tenants in the entirety, life insurance, property over which the decedent had a general power of appointment. The IRS looks upon that as you got complete control of it, it's yours. Community property to the extent of the decedent's interests as defined by what? Applicable law, which means the state law. Now, once you've determined the gross value and you got the gross estate, you have to determine, hey, what do I have for expenses? Well, you're going to have funeral expenses. The decedent may have debts. He may have mortgages, credit card bills. He owes people things. Marital deduction. That's the money, that's the property that transfers to the spouse tax-free. There are quite a few deductions involved. Then you have administrative expenses. Fees paid to the fiduciary for administering the estate. Attorney fees, accountant fees. You got to prepare Form 706, preparation fees. Expenses incurred for the management of property. So there's a lot of expenses involved. So we have the gross estate, and then we have all these deductions and expenses. And then we also get the marital deduction. All property that is included in the gross estate and passes to the surviving spouse is eligible for the marital deduction. Now, you have to make an election to do that. It doesn't happen automatically. You have to make sure, it might not be the best thing to do, but it's available to you. We also have charitable deductions. The decedent can give away things to charities. Nothing that prohibits him from doing that or her. Could be all sorts of charities, as long as they're qualified charities. So you'll have the gross estate You have the deductions, you'll have the administrative expenses, you'll have the marital deduction if there is any, you'll have contributions. That'll give you the adjusted gross estate, and then you'll have your taxable estate. So, how do we value everything? Well, we value it as what its fair market value is as the date of death. So it's going to be the date of death. But the representative or the executor, they can value everything 6 months later if they wanted to. It's known as the alternate valuation date. But you can only use that if it lowers the estate tax. That's all. And if you're going to value things 6 months later at the alternate valuation date, you have to include everything. You have to value everything as that. So you may do it because maybe you had a lot of stocks and the stock market went down. Maybe you had real estate and there was a big decline in real estate prices. It'd be something you might want to do. Now, part of the transfer tax system is also, along with the estate tax, is the gift tax. And this is a good tool for people to use to help reducing their estate. What is a gift? It's a transfer by a person to an individual, makes a gift, and they're expecting nothing they receive nothing in return. They give up complete control of it, and they've given that gift. And how much can you give away? Well, you can give away up to $14,000 a year to any one individual. There are exceptions to the gift tax. For instance, if you pay tuition or medical expenses for somebody, there's no limit to how many of those you can pay. But you have to make the payment directly to the facility, directly to the educational institution, or directly to the medical provider. Gifts to an individual spouse, no limit. Gifts to qualified charities, you get a deduction for these. So what's the limitation? The annual exclusion is $14,000 to one to each and every individual. You can do that. Now, married couples, if they wanted to, the gift splitting rules apply. They can say, look, we're going to give $28,000 to this one person, $14,000 from me, $14,000 from my spouse. And even if one spouse gave someone $20,000, they could elect to call that a joint gift, and they would be below the $14,000 threshold. That's known as gift splitting. Both spouses must agree to split the gift. If the consent is given, each spouse can take the annual exclusion for his or her part. In 2013, for example, gift splitting allowed married couples to give up to $28,000 to a person without making that a taxable gift. Filing a gift tax return, you have to do it by April 15th of the year following. So here we are in 2014, you'd have to file the tax return by April 15th, 2014. And it's due. And you have to be very serious about this. If you have a gift tax due, file it. Don't fail. And the third leg of the transfer tax system, we've got the estate tax, the gift tax. We also have what's known as generation skipping tax. Sounds complicated, but it's a simple concept intended to prevent families from avoiding estate taxes. So you have someone who says, my children are doing all right. I'm not going to leave anything to them. I'm going to leave everything to my grandchildren. So you're skipping a generation. That's what that implies. And a gift tax, generation skipping tax is due when a transfer of assets is made to a skip person. And a skip person is determined by looking at the generation assignments applicable for family and non-family members. Generally, the gift tax will be imposed on the assets transferred to a family member 2 or more generations below the decedent. So you'd have your children and then your grandchildren. That's 2 generations below. The law does not distinguish between persons who are whole blood, half blood, or adopted relatives. Regardless of the age difference between spouses, they are always considered to be of the same generation. What's the tax rate? Right now it's 40%. So unlike the graduated tax rates for the estate and gift taxes, the GST tax is a flat rate of 40%. And that's just an overview. So when you think of the transfer tax system, think of gift tax, generation skipping tax, estate tax. Think of gift taxing, $14,000 exclusion per person. Splitting gifts could be $28,000. You think of the estate tax, remember the $5,250,000 exemption. Remember, there's a marital deduction that you can use if it's in the will, if it's decided you want to use it. You have the gross estate, which is the value of all of the assets. Then you take your expenses, and you're going to get your adjusted gross estate. Then you may have some marital deductions and charitable contributions. Then you'll have a taxable estate. That's very simply the transfer tax system. Thank you.